Hi. Across the world, whether it's in the UK, Companies House, the US SEC, Securities and Exchange Commission, or any jurisdiction with a formal business registry, companies are required to submit periodic financial reports. These aren't just administrative checkboxes, they serve as the backbone of governance, transparency, and strategic oversight. These filings fall into a few familiar categories. You have the annual financial statements, you've got the annual returns, you've got the tax filings, you've got regulatory compliance reports as well. These reports are more than mere regulatory formalities. They shape investor sentiments, influence strategic decisions, and provide a window into companies' financial health and operational integrity. Let's start with the annual financial statements. These are the cornerstone of financial reporting, offering a very detailed account of a company's financial health. You see, you've got a balance sheet where you have a snapshot of the financial position showcasing assets, liabilities, and equity. Then you have the income statement, which reveals how profits are generated, detailing revenue, cost, and net income. And on the back of this, you then have the cash flow statements, which tracks liquidity by mapping cash movements across operations, investments, and finance. And then that leaves now with a statement of changes in equity that captures shareholder movements, including retained earnings, dividends, and share transactions. And the notes to the financial statements is where we now start to peel behind the onion, providing essential context, clarifying accounting policies, assumptions, and key disclosures. Together, these reports paint a holistic picture, both qualitative and quantitative. However, they must meet four critical criteria. Number one, you've got value, where every number must faithfully reflect reality, complete, consistent, and material. Then you've got time. Report must align with relevant periods, be timely enough to drive action and enable year-over-year comparisons. And then quantity. Financial data must be precise, correctly aggregated, and meaningfully presented. And then transparency. The disclosures must be robust, ensuring auditability and regulatory scrutiny. So here's the situation. These annual filings are culminations of daily, weekly, and monthly activities. What's captured once a year, it's only possible through what happens through the trenches each month. That's where monthly management reports, though optional, are foundational. If you don't track, measure, and report throughout the year, the annual report becomes guesswork, and investors, lenders, auditors don't want stories. They want systems. So with all of that said, we now step into something that you hear, cross-finance, and that's the model. And these must reflect these standards. These reports aren't just end-of-year artifacts. They are the foundation of how business measure performance and engage with stakeholders. Let's take a look at what each report contributes with regards to their unique lens. The income statement explains how value is created. The balance sheet reflects long-term stability and risk. The cash flow statement highlights liquidity and operational efficiency. In the world of FP&A, we don't just produce these reports and then back off. No, we model them. We build the engine behind them. That engine is the financial model, and not just any model, but a fully integrated driver-based and interconnected nested suite that reflects how the business operates in real time. Now let's step back and ask a fundamental question, which is, how do we make a financial model robust? These are not templates. They are not plug-and-play spreadsheets. A robust financial model is a structured framework that integrates historical performance, live operational data, and then forward-looking assumptions. Done right, it forms that single source of financial truth, not only powering accurate annual reports, but enabling budgeting, forecasting, and scenario planning all through the year. Let's start with full integration. A well-built model is what you have in a truly integrated model. The income statement, the balance sheet, and cash flow statements are all interconnected. If revenue increases, net income changes, retained earnings update, and that change flows through the cash flow automatically. There are no dead ends, no broken links, just one version of the truth. But we don't just stop there. Complex business require a suite of models, not just one. For example, revenue planning models that use the exact drivers for the revenue streams from the contract database, pipeline sales from the projection of sales by product line, customer segment, or geography. And then you have your cost models that map headcounts, technology spend, or cost of goods sold by operational unit. Then you have your capex plans, workforce planning, and scenario stress tests. All of these roll up into the consolidated financials, but remain flexible enough to be updated independently. And then we apply driver-based logic methodology, linking every outcome to an underlying business driver. Revenue is driven by unit, volume, and price. Headcount is driven by FTEs and compensation data, start and end dates, financing tenor, interest rates. This approach does more than improve precision. It brings the numbers to life. In practice, FP&A becomes the strategic nerve center of the business. Integrated models ensure actuals are accurate and forecasts are reliable. Interconnected models ensure that teams work from the same playbook. Driver-based models ensure assumptions are grounded in reality and easy to challenge, update, or optimize. And this empowers the business to do the following: forecast with clarity, plan with discipline, adapt with speed, report with confidence. And whether you're preparing for an audit, meeting, or just monthly management review meetings, an investor update, a board meeting, or simply trying to understand why cash was tight last quarter or last month, this level of modeling delivers answers, not just only fast, but accurate as well. This all underscores a critical truth. There should be no gap between how we report the past and how we shape the future. That's exactly where FP&A earns its seat at the table. By building models that are not only technically sound but operationally connected, FP&A becomes more than a reporting function. It becomes the system through which performance is understood, risk is managed, investment is guided, and value definitely created. So let's start with a comprehensive guide to this fully integrated financial planning model. The journey towards integration, how the model was built. This walkthrough is the latest iteration of the version of the nested suite of fully integrated model. It is a product of over a decade and some of continuous refinement, practical application, and business partner-driven evolution. Back in 2008, during the pivotal FP&A leadership role, I brought together multiple individual models, each designed to address a specific function: workforce planning, revenue forecasting, cost management, capital allocation, and more. The objective then was clear: integrate these operationally isolated models into a single, fully connected framework, a financial model that outputs directly into three principal financial statements: the profit and loss, the balance sheet, and the cash flow. From that point onwards, year on year, company after company, this integrated model became not only a consistent tool but also an ever-improving platform. Each new deployment created opportunities to upgrade, many of which came from where they mattered most: collaboration between partnering sessions with department heads, insightful inputs from CFOs, CROs, COOs, and other members of the C-suite, and most importantly, the identification and elimination of non-value adding model elements that created friction or added noise without delivering meaningful insight. The result? What you now have is the latest and most advanced version of a fully integrated driver-based financial model, purpose-built to meet the planning, the forecasting, and the performance analysis needs of dynamic businesses, each tailored to mirror real operational drivers just as they occur in businesses. While each individual model serves a distinct purpose, they all feed into and rely upon a shared structural logic and assumptions based on things that you'll find in accounting. You will learn the purpose of each model component, the required input, whether it's sales, HR, or operations or accounting, the outputs they generate, and how these inform the three core financial statements, and how the system maintains coherence, accuracy, and real-time responsiveness throughout. Starting with the very first input model right here, permanent employees planning. I use this button here to import the data from the HRIS and click on that, and then it goes to retrieve the relevant fields, which we're going to see in a second, and that's now fully populated. So we see we've got the employee ID, the resource name, the department, the company, the job title, the line type, the annual salary, the FTE, the daily standard hours, the bonus percent, the recruitment, the VAT on recruitment, the line type, the applicable day payment outstanding, start date, end date. And then from there, we then have these computer sections. We have the days over 5 years, and these are further expandable to see the month-to-month view. And then we have the monthly basic salaries and wages. And then we have the monthly bonus and accruals. We have the basic salaries and wages, employers' national insurance. We have the bonus accrual, employers' national insurance. We have the benefits, health, etc. We have the pension. We have the recruitment calculated based on the percentage payable to any recruitment agency. Then we have the office equipment, laptops, mobile phones, the whole 9 yards. Then we have the depreciation of this office equipment. And then you have the VAT recruitment and office equipment cost. And then we have the trade payables as a result of the DPO. And then we have any other cost, staff cost, headcount joiners, headcount leavers, headcount brought forward, and then the total line cost. From there, we now go to the next one, which is the temporary employees planning. We do the same thing using this command button here, hit that, and then it goes to the human resource information system, imports the relevant fields. We have the employee ID, we have the resource name, we have the department, we have the company, job title, and then we expand here to see for them. And then we have the daily rate, FTE, VAT on recruitment, applicable day payment outstanding, the start date, the end date. And then from there, we now go to the days, and this instance here, we're using the working days. And then we have the monthly cost, the monthly VAT trend, the monthly gross trend, the monthly cash trend, the monthly payables trend, and any other cost, staff cost, headcount joiners, headcount leavers, headcount brought forward, and then we have the total line cost. From there, we then go to the subscription revenue. Using the command button like before, we hit that, and then this has now gone to the contract database to import the customer ID, customer name, revenue stream, company, line description, line monthly unit amount, line unit quantity, commission payable to the sales team, VAT rate percentage, line duration, applicable days sales outstanding, line type, start date, end date, line net amount. And then from there, you now have the recognizable days, deferral, monthly recurring revenue, monthly deferred revenue, VAT amount, the gross amount, cash receipts, trade debtors, customer count won, customer count churn, customer count brought forward. From there, we now go to the next one, which is the subscription cost of revenue. Same, use that to go to your contract databases for your payables. This time you have the supplier ID, supplier name, costs of revenue, company, line description, applicable day payment outstanding. Use that to see the line quantity, line unit quantity, VAT rate percentage, line duration, applicable days, payment outstanding, line type, start date, end date, net line amount. From there, you now have the recognizable days, deferred days, the monthly recurring cost of revenue, the monthly deferred cost of revenue, VAT amount, gross amount, cash payment, and then your trade payables. The next one, this is the services revenue for professional services. This feeds off using the contents in your permanent employees here. And then from there, you have your employee ID, the resource name, the department, the company, project description, the start date, end date, rate per hour, applicable days sales outstanding, hours type. And then from there, you then have your networking days. And then you have your client hours in quantity, client order hours, professional development hours, statutory holiday hours, total hours in quantity, consulting income, which is the match between your client hours and the rate per hour to have your realizable revenue line by line for every resource. Next one is your transaction based. Use the same command button here, hit that, and then that goes to your contract database to import the customer ID, the customer name, the revenue stream, the company, line description, line monthly unit amount, line unit quantity, margin percentage, VAT rate, applicable days sales outstanding, line type, effective date. From there, you then have the product revenue, product cost of revenue, VAT amount, gross amount, cash receipts, trade debtors, count of your customers. And from there, you have your overheads. Use this to import the relevant fields, and that's going to give you your line ID, supply, overheads category. Expand here to see the following: the company, the line description, net line cost, invoice date, VAT rate percentage, effective date start, effective date end. From there, you then have your recognized days, your deferred days, your monthly overhead cost, your monthly deferred cost, your VAT amount, your gross amount. From there, you then step into your cash book. Here, just a quick one, just to walk you through some of the key ones. You have your type, investment, amount, interest rate, your tenor. The type here specifies whether the funding is equity or loan. The investment type describes the specific type of funding, such as seed funding, Series A, term loans, you name it. Amount indicates the investment amount in local currency. Interest rate denotes the applicable interest rate for loans. And your tenor, duration, specifies the duration or tenor of the investment, such as the term length for loans or the funding rounds for equity investments for involving credit lines or convertible notes. Specific terms are mentioned. So that was just a quick one. And then from there, you now do the same. Go and import your relevant data set from wherever you hold them. From there, you then have the reference ID, the provider, debt, equity, description, company, the amount, effective date, type, rate, duration in months, repayment types, alternative end date, line description, loan end date. From that, the model then computes the recognized days, cash inflows, cash outflows, scheduled payments, scheduled interest, scheduled principal, and your closing balance. From there, you then go to your capex, capital expenditure. Use this to go to your fixed asset register to import the relevant fields. And off the back of that, you then have your reference ID, your supplier, your asset group, your company, your asset description, your amount, your effective start date. Does it include stamp duty or not? Alternative end date, your line description, your asset life, calculated days, asset end date. Using those relevant fields, you then have your recognized days, your capex amount, your VAT amount, your monthly depreciation, your accumulated depreciation, and your net book value. All of that populated now gave us the opportunity to now have a walkthrough of the detailed principal financial statement. You have these buttons to expand and collapse. You have these buttons to expand and collapse as desired. Top, you have the profit and loss statement. Further beneath, you have the statement of financial position or balance sheet. And then thereafter, you have your cash flow statement. Then your key performance indicators, subscription count, your total hours, and then your financial runway. Running back to the very top, I'm now going to expand rather quickly. And you can see that you have the position to see your various revenue streams. And here you can expand further to see the streams line by line, and then your subscription revenue. And you can expand to see your consulting revenue streams. And from there, you can now go see your gross product cost of revenue. And then you can expand to see your subscription cost of revenue. And you can now take your time to see the cost center reporting. You click on it, you can see that it highlights where, when you're doing your presentation, that gives you the chance to see exactly, to focus on exactly where you're talking about and what you're talking about. And then you can expand to see the salaries, employers' national insurance, which are feeding off what you inputted into here, your employers' national insurance, your commission, your bonus, commission and overtime, vacation pay, employers' pension contribution, the benefits, travel and entertainment cost, staff cost, other professional services, and then your recruitment cost. From there, you now go to the line which is taking care of your contractors and other temp costs and all of that direct cost. You can expand here to see the month-on-month view, and you can expand further to see the various ones for the various cost centers. In this particular model, I have used these as a demonstration. And then you go further down to see your promotional and marketing expenses. And then further, you have your occupancy, These are all using these exact business drivers that are going to be your start date, the line amounts, and the duration. And then you have your professional and statutory expenses. You go further beneath, then you have your depreciation calculated from your capex, your fixed asset register, using the relevant fields. And then you have your finance cost using what you have in your financing agreement. And then you have your balance sheet and so on. Off the back of that, we now go quickly just have a look at the management reporting packages. Here you have a view which is as follows. You have the profit and loss, the balance sheet, and then the cash flow statement, key performance indicators. Selecting these, you have your P&L, your balance sheet, your cash flow, key performance indicators. Here I've got profitability ratios, liquidity ratio, activity ratio, your debt ratio, your customer ratio, professional services ratio, your general business metrics, your departmental head count closing. And then here we have the transformation impact reporting, profit and loss, balance sheet, and cash flow statement. Profit and loss at the top, balance sheet, cash flow, key performance indicators, service hours, total hours, subscription, average revenue per unit. And then you see exactly what has happened post-transformation, pre-transformation, impact year on year, and then the percentage changes. Then you have a different format here, which is pre-transformation, impact year on year, and then year on year percentages, and you end up with your post-transformation. And then you have your departmental P&L that gives you exactly the position. You select these, and then once you've done that, you can now ship these off to your respective internal and external stakeholders. So what I've noticed is that throughout this journey, I have aimed to show how a fully integrated driver-based approach to FP&A doesn't have to be overwhelming or abstract. When built properly, it becomes something practical, something that genuinely supports the day-to-day work of finance teams, senior leaders, and operational managers alike. It's not about spreadsheets. It's about frameworks, logic, consistency, trust, and ultimately, it's about enabling faster decisions, confident that every number is backed by structure, not speculation. So, the next time you read a financial statement or prepare one, pause and ask, does this reflect how the business actually works? Is this just reporting what's happening and what has happened, or is it helping to shape what comes next? Because behind every line item should be a model, behind every model a logic, and behind that logic a framework aligned with your business reality and not just your accounting rules. That's the kind of work I do. And just a bit about me. My name is Hamilton Alogaga. I'm an ACCA qualified accountant with well over a couple of decades of experience in financial performance management reporting, offering FP&A as a service. I began as a management accountant, learning the mechanics from the inside. From there, built models, partnered with product and commercial teams, led FP&A functions, and now I deliver all of that as a service, agile, modular, and scalable. I have supported startups trying to turn vision into discipline, further supported PE-backed businesses that are translating strategy into performance, and along with these, the big ones, PLCs, pushing for clarity and complexity. Teams that are navigating M&A, scaling transformation, and interim transitions. Whether it's an interim role, project support, or building FP&A from the ground up, I bring practical, ready-to-deploy solutions driven by operational logic and tailored by your needs. So here's the thing. If you're growing fast, preparing for a fundraise, managing a board with sharp targets, or just trying to make sense of messy spreadsheets, FP&A is your engine room. It is the only function built to bridge what happened, what's happening, and what should happen next. And driver-based FP&A, done properly, becomes the single source of clarity across teams, functions, and investors. If that's the kind of support you're looking for, then let's talk. We can then walk through your actual data and explore how my structured, operationally aligned FP&A system will definitely reshape your decision-making process, and immediately. No fluff, no guesswork, just models that reflect how your business actually works. The very first step is very simple. Reach out. For now, until then, happy financial planning analyzing your companies.